A common phrase I like to use when trading is the majority is always wrong and the biased are always late. In today's video, we're going to be reviewing the higher time frame charts, looking at the technical and structural data, as well as discussing why the majority once more could be incorrect about the current move. Let's go ahead and jump into the video. Okay guys, welcome back to the channel. I hope you're all having a fantastic Sunday. We're here to take a look at Bitcoin, guys, on the higher time frames. As we already know, Bitcoin has corrected around 20% since we had the weekly shift in momentum at 30,000. According to the chart over here, you can see we had a breakdown of the 62 point on the histogram on the RSI, which actually signified a shift in macro momentum from strong positive to weakening positive. This resulted in a 20% correction, as we have seen the prior few times we have seen this as well, resulted in quite strong rejections. In today's video, however, we're going to be discussing how this correction could potentially be coming to an end, where we expect it to come to an end, and what will it take for this correction to actually continue and push the prices even lower. We're going to be reviewing the economic data, the macro technical data, the macro structural data, and of course the short-term price action. Before we get into it, smash the like button, hit the comment button, and guys, subscribe to the channel. We do daily videos for Bitcoin. We focus on the facts, the data, the technical and structural information, all the probabilities, and of course we keep it nice and objective. No emotion, no hype, no BS. If you're interested in more of that kind of content, you can join us on our Telegram. That is the second link down below. You get access to charts, updates, analysis, educational posts, news events, information, and so much more in here. If you're interested in VIP trading signals, you can join our VIP channel here. We post daily trading signals of entries, targets, stop losses, etc., etc. We give you exclusive analysis and so much more, including our entire trading group chats. We have 4 different group chats going on: our trading and charts, our general chat, our help chat, and of course exclusive altcoin analysis. If you want to know how to join that, go to our free channel, click the pinned comment, scroll up to the top. You can join us via here by clicking my name over here. Let's go ahead and get started with the market data. So currently, guys, for the month, Bitcoin has been down 8.6%. As you would know, we have seen a steeper correction, 8.6%. We've been around 17% since that top at around 30,900. But for the month open to where we are currently, we're down around 8.6%. It is of course a weekend, so we do expect volume and volatility to be on the decline. We can see 24-hour volume is only at 43 billion, down 50%, and 24-hour liquidations is down a whole whopping 71% at a very, very low 37 million. As for our volatility index, we can see the 30-day volatility index did take a little bit of a nosedive towards 2.08. And of course, the 60-day volatility index has been falling off a cliff to 2.4%. As for those liquidations, if we do take a look at the breakdown, we can see over the last 24 hours, we have been very, very choppy. We are in a chop zone. We have seen both longs and shorts liquidate. And this kind of liquidation pattern is very common to see as we progress sideways, as we push sideways within a higher time frame structure. And the structure we are pushing sideways in, of course, is going to be a descending channel. We'll discuss that when we get into a short-term price action. The DXY has broken out of its higher time frame downtrending resistance. This downtrending resistance has been in play now for 200 days. So a very significant downtrending resistance. As you would know, we're telling you for weeks and weeks and weeks, we had a double bottom formation over here. We saw the short-term signals of a breakout incoming. And we said if the DXY does break upwards, we are going to see the stock market fall. We're going to see Bitcoin reject from 30,000 and continue downwards. We have actually seen that. We've seen the stock market take a nice little move toward the downside. They are rejecting from their yearly resistance levels over here. And of course, on the Dow Jones right over here, they are moving downwards. And of course, we have seen Bitcoin reject as well from 30,000, taking a nice move toward the downside in the process. The same goes for the DXY, guys. If the DXY continues upwards here, we can expect that downward move to actually continue for stocks and for Bitcoin. If, however, this downtrending resistance does not provide any substantial support, and we do not maintain the price above this level, and we reject under it, breaking below the support, we can expect both stocks and crypto to actually bounce and rally quite aggressively. If you look at where the stock market is, we can see on the S&P 500 over here, we are just underneath a a 1 year long plus. This is a year long plus of resistance. It's 460-day long resistance. If we break through that neckline, as you would know, strong resistance becomes strong support. So if we do break that level, we will be continuing up. However, until then, we are in a bearish structure. This is a rising channel formation. If the stock market does correct, if DXY continues upwards, we do have a potential to come down to retest this uptrending support line. If this level is lost, we can expect a continued crash in the market. Now, as you would know, price action is determined by economic drivers. Economic drivers are the main reason why prices move on the macro scale. If we look at why prices move in certain directions on the macro scale, it's very, very tied to what the economy is doing, but not specifically what the economy is doing, but certain economic drivers of price action. The main economic driver of price action is going to be interest rates. And we're going to discuss how interest rates and how, of course, the month of May, the economic data we have, which was CPI, NFP, and PPI, how those economic leading indicators can impact interest rates going forward, and how the impact of interest rates going forward could potentially shift the macroeconomic perspective for our asset prices. It can shift the narrative, it can change the trajectory. As we would know, ever since around November last year, interest rates, inflation has been starting to get a little bit more positive. We're seeing the rate of growth on interest rates decline, the trajectory is moving down, and we're seeing inflation come down. Ever since then, as interest rates had been moving toward the downside, meaning not the total rate, but the rate of increase has been moving down, we've seen asset prices rally. Not only stocks, not only Bitcoin, but we've seen asset prices in housing markets see a little bit of a come up, a little bit of a bounce over the last few months. But if that flips around, we can expect the opposite to occur. We'll get into that in just a moment. I wanted to briefly interrupt today's video to discuss my favorite exchange, Bitget. If you're looking for a safe, honest, reliable, and accurate exchange, look no further than Bitget. You can sign up by the link in the description to support the channel and get access to 3 exclusive perks. That being up to $5,005 in trading rewards, up to 15% discount on your trading fees, and exclusive access to our MegaWhale promotion campaigns that we run every few months. Alongside that, guys, Bitget is a non-KYC exchange, meaning you do not have to KYC. It is completely optional. Bitget also has a protection fund that secures user assets against external hacks and threats in the space. Alongside that, guys, Bitget offers up to 125x leverage on futures with extensive amount of trading pairs and liquidity on the market. I highly recommend signing up to Bitget. It is the exchange I've been using for over a year and a half now, including all of our members. If you're interested in signing up, trading there, and supporting the channel, you can do so with the link in the description. Thanks for listening. Let's go ahead, guys, and start to talk about Bitcoin on the macro chart. As you know already, we did see a significant break of the 62 point on the RSI on that weekly chart. This was determined by that horizontal break of the 62 point on the histogram. You can see I've gone ahead and drawn in red vertical lines every time we have seen that in the past 5 years. And every single time we have seen a break from the top side down that line, it has resulted in quite a significant pullback. In fact, the smallest pullback we have seen from that was this one over here of around 20%. Currently, this is around 16 to 17%, so it could be the smallest, but nevertheless, even a 17% correction on Bitcoin is undoubtedly a large correction. That's multiple billions and billions of dollars wiped off, stripped away from the cryptocurrency total market cap. So it's an absolutely huge move, guys. It is not a small move by any regards. The cryptocurrency market is becoming quite large. It does have a fair bit of money in there. So a 16% move in a few days is actually quite significant. So the 62 on the RSI does suggest still that this weekly momentum is moving toward the downside. And that opens up the possibility for a continued correction. However, we need to be taking a look at some other indicators. So let's review our 50 EMA, our 200 EMA. As we said in yesterday's video, a very probable bouncing point for Bitcoin is going to be the 200 moving average on the weekly. And not only the 200 moving average, but the Gaussain channel midline. And as you can see, if we zoom in, we actually perfectly bounced right between those two levels. The Gaussain channel midline on the weekly and the 200 EMA on the weekly chart. Right now, we are actually bouncing in a pretty strong short-term / temporary support zone. If we go to the smaller time frame chart, you can see according to that VRPV, the gap we had over here has now been filled to some degree. We've got a fair bit of volume in here. We've got a fair bit of chunks. We have a fair bit of historical orders placed in this range. We are actually developing support between 26.8 and 25.2. So the main question is now, are we going to see a full correction to 25.2, or will this support here hold, which will facilitate a early bounce up and leave the majority of people who flipped bearish under this resistance wrong again? Because we flipped bearish at 30,000. We took profits on our shorts under this resistance, as we've said in our group chat, as we've said in our free Telegram channel. We told you exactly what we were doing, and now the majority are starting to flip bearish. The majority are calling for new lows. Majority are calling for doom and gloom. Is this going to be the start of a higher time frame continuation downwards, or will they be wrong again and the correction come to an early end? And we'll be discussing that when we get to the short term. So let's discuss the possibility, guys, that this level is going to hold as support. So if we look at this chart again, what we can see is we have that crossover here of the 200 and the market cipher, and the Gaussain channel midline. This is a decent level of support. I will not be expecting a continuation lower unless this level is lost. $26,000 is going to be acting as a temporary support between the 26.8 and 25.2 to 24.4 major higher time frame support. If that level is lost, we can expect a higher time frame continuation lower. Not only do we have the confluence between those technical indicators, we also have the bull market support band acting as a temporary support a little bit lower down. And as you can see, we draw in our main chunk of support over here between 24.4 to 25.2. You can see that lines up quite well. However, guys, we do have quite a bearish monthly candle here on the higher time frame. We have a bearish engulfing candle. Of course, this has not been confirmed. We have 17 days left until the candle closes. But if we do close this candle as is right now, the bearish engulfing candle, that can be a sign that the monthly chart is going to reverse, and we could see that move even lower. We'll be discussing that in just one moment. So before we talk about this chart, let's go ahead and define our daily levels. Let's talk about what is actually happening. So ignoring the technicals, ignoring the lines, ignore everything but the price action and these zones. As we can see, we have two most important levels I want to discuss. Number one, the $30,000 to $28,000 major yearly resistance. This is going to be a yearly long resistance level that spanned over 900 days, okay, precisely 878 days. This has been the resistance we have been challenging now since the start of April, late March. As you can see, it also provided a yearly long base of support for the all-time high slash explosive parabolic move of the bull run in 2021, early 2022. So this is the bull run low. And as you would know, strong support becomes even stronger, if not as strong, resistance. And that is why we're having so much problems breaking over this level. If we look lower, our next major support level is going to be defined by this green zone. This is just as strong. This is a 280, now 330 day long support level, meaning this is the nearest strong macro support on the current chart. This is an incredibly important level that we need to hold above to maintain the weekly uptrend. And I say the weekly uptrend because if we go back to this chart over here, if we bring those macro indicators back up, the Gaussain channel with 200 moving average, all of these indicators are converging above that trend line. They're all converging above this level, meaning between this level here and this level here, we have technical support. Okay, we have technical support. A loss of that level will drive momentum down and push the price underneath the support range. So we do have a key shift of the weekly trend below 26,000, and from a structural level, a key shift bearish of the weekly trend below 24.4. There was absolutely no need to get macro bearish yet unless 24.4K is lost. But like I said already, there's no need to get macro bullish yet either until a monthly candle closes above 30,000. Currently, as we've been saying, we are in a weekly uptrend. We bought at 16.5K, we sold at 30,000. We had an 88% gain. The move played out perfectly. We're currently retesting macro resistance. We have macro support. There is no need to be expecting new lows. Everyone calling for new lows is calling for new lows based on speculation. Their supports, their claims have no support besides speculation based on potential developing economic data. We have to look at the developing economic data and shift our narrative based around what the data is actually saying. We'll discuss that in a second, because yes, there is a potential to go to all-time lows. There is a potential to break below 15,000, but it's not going to be due to what people are saying. It's going to be due to something else, and we'll discuss that in just one moment. So let's talk about the 4-year cycle, and we'll talk about the potential for new lows, and we'll get into short-term price action, and then wrap up the video. So, the 4-year cycle. As I just said, there is no need to get monthly bullish. There is no need to get macro bullish. We are not in a bull run. Everyone's saying we're in a bull run this entire way up. I was telling you guys, we're not in a bull run. We're in a macro reversal. It's looking very good, but we're not in a macro uptrend. We're not in a bull run. The criteria for a bull run has not been met. The criteria for a macro uptrend has not been yet met, but we are in a strong move upwards. This is a reversal move. For a macro uptrend to begin, we need to close a monthly candle above $30,000. If we look at the prior cycles, every single time we have closed a monthly candle above $30,000, it has resulted in a strong push to the dotted trend line. The dotted trend line being the first high of the first dead cat bounce after the bull run high. The bull run all-time high, we come down, we retest that yearly low. Okay, retest that yearly low. We come up, we retest that dotted trend line. That is going to be our dead cat bounce high. That is going to be our dotted trend line. There is a point we're looking for. So every time we close a monthly candle above that level, we end up seeing a strong rally over the next 3 or 4 months towards a dotted trend line. Meaning, if we close a monthly candle above 30,000, we're almost guaranteed. I say almost because nothing is a guarantee in trading, but we're almost guaranteed based on our historical data and what would be our structural data. Because if we do break 30,000, we're clearing this yearly low, which is absolutely phenomenal. This is a phenomenal resistance. This is a huge resistance. That'll give us the pressure we need to push upwards. We'll most likely see a move towards 48,000, okay? At 48,000, we generally see a strong rejection that lasts two or plus months. This rejection could take us down, back towards the dotted trend line. It could take us down to 40,000. Who knows where it's going to take us? I'm not going to try to speculate, but it will most likely take us back down. The bull run really starts to kick off when we get 3 things occur. Number 1, the monthly candle closes above that dotted trend line, and that suggests a shift in higher time frame volatility, okay? Number 2, a break of the date range trend, meaning we need to actually meet that date range trend. According to the prior cycles, we're generally seeing about 16 to 17 months between bottoms and the bull run starts. We see March to April 2024. And number 3, we need to break the Ichimoku cloud baseline, which I can go ahead and bring up now. The Ichimoku cloud baseline is a momentum trigger on the higher time frame. As you can see, every single time we cross over that red line over here, and again, red line over here, we generally continue upwards. So for a bull run to start, we need to see those validation points. The main and most important one being the monthly candle over 30,000, because that's the first one. If we don't get the first one, how the hell do we get the rest of them, right? We need to get that first one. That first one needs to be in check. Now, a lot of people are saying, okay, we're under 26, we're crashing, we're rejecting 30,000, we're going to new lows, we're gonna crash, we're gonna burn. Here's the thing, guys, and I've talked about this a fair bit. A lot of people, you have to understand, a lot of people, when it comes to analysis, they focus on simple indicators such as the MACD, okay? Such as the RSI. And RSI, is by all means, it's a simple indicator, but to use it effectively is very difficult, right? You have to actually understand what it's saying. You're not just looking for oversold, overbought. You're looking for shifts in momentum. And shifts in momentum aren't visibly present on the RSI unless you know exactly what to look for, right? So by all means, it's simple, but it's still complex. But the majority of people base their understanding of direction on lagging indicators. They use moving averages, right? They use MACD. They use these derivatives of momentum, such as stochastic RSIs. These are good indicators, but they're not good for predicting direction. They're good at predicting strength. Strength can determine direction, but not always. They can leave you with your hand out, waiting for the move to occur that never occurs. And I like to say always, as a move progresses, as it becomes more and more obvious on the chart, the move is less and less likely to continue, slash the move is more likely to have been already completed, if not nearing the end of the correction. We flipped bearish at 30,000 because we saw discrepancies between price strength and momentum. We saw volatility, volume, speed and velocity were falling, okay? And all of this, the breakdown of the 50 MA, the crossover midline, the loss of a 26.8k level, all of that is a result of the weakness we saw here. It's not the other way around. This doesn't determine the direction. The weakness we saw here determined the direction, and this is the result of the weakness we prior saw. So if people are determining where the price is going to go based on the result of weakness, they're going to most probably be late. And this isn't me saying we're not going to go to new lows. I'm going to talk about that in a second. This is me saying as we approach more obvious moves, as the majority flips their bias and it becomes more and more widely accepted that a certain direction is locked in, that is when that particular move is actually closer to the end than most would actually assume, because the majority are not looking at the metrics of data to base their analysis. They're looking at the results of the metrics. And if you look at the results of the metrics, it means you are late to the move. And that is why I say the majority are always wrong and the bias are always late. So watch out for that. So what are the potential to go to new lows? How can we go to new lows? And we'll talk about the short-term price action. So there is basically one way. Well, there's a few ways, but there is basically one main way we can go to new all-time lows. And as you know, for the price to drive, we need economic drivers. There are certain drivers of macro price action. So right, drivers of macro price action. We have economic, political, and social, EPS, okay? These are the main drivers. Let's take a look at the social. So social, we have public perspective, for example. Public perspective, public opinion. If you take a look at the banks who are collapsing, people lost faith in the traditional banking market. They were looking for different assets to hedge their wealth, to hold stability, hold their wealth in, and a lot of people moved to Bitcoin. And that is one of the main reasons why we saw Bitcoin massively outperform the stock market, because people were moving their cash into alternative sources of wealth. They moved their money into Bitcoin. We saw Bitcoin rally significantly when the banks were falling. So that is one. Number two is political. Now, political has two effects. Obviously, political can be positive or it can be negative. But usually political doesn't determine direction. It basically either suppresses or it enhances movement. Meaning, if they ban Bitcoin in scenarios, that might suppress people's access to the asset, but there are ways around that. If they support it, they add it to 401ks, they add it to superannuation, that is going to support the progress of Bitcoin and the asset class, and therefore make it easier for the asset class to rise. And the next way they do it is they either speed up or slow down the implementation of economic policy that can directly influence asset prices. So that leads us to the main one, which is economic. And the main influence of economic on asset prices is interest rates. Now, interest rates directly determine the asset prices in that direction, because interest rates is what controls market risk. Interest rates completely controls market risk as it influences the cost of debt. If the cost of debt rises, the amount of money you need to service that debt rises. So if your income producing assets start to lose value and thus produce less income, you have a higher debt to service ratio. Therefore, you need more income to service those assets to produce income, and the whole system starts to become either too risky or negative. And that is why a lot of companies sold off their assets, sold off their stocks during the economic downpour. And that's why a lot of companies have been obviously losing a lot of money. If you look at the flip side, when interest rates start to pivot and go negative, the opposite occurs. Debt becomes cheap. Companies acquire assets on debt to produce income, which pushes the share prices upwards and the asset classes increase in value. We can look at it from a company, organization, institution perspective, or look at it from a consumer perspective. If consumers have more available cash because their debt service ratios are lower, because their short-term and long-term loans are cheaper to service, they have more money to invest. They have more money to invest, more retailer purchasing assets, pushes the price upwards. If home loans start to increase in value or increase in debt requirements because asset prices are risen, people have less available cash. They're more likely to sell their risk assets. They're more likely to sell their investments to service their more important debt, which is of course like a home loan or a short-term loan that's massively rising in value or repayments. So if we want to see the macro direction of asset prices shift, we have to see a shift in the driver of these macro asset prices. things don't just randomly happen in the market. Asset prices don't just spontaneously decide, okay, we hit $30,000, we're going to go to 4K. It doesn't work like that, guys. There are drivers of price action. This stuff is not stuff they teach you. You don't get taught this at university. I've gone to university, I've done economics, I've done finance, I've done accounting. They don't teach you this stuff because they're not trying to teach you how to make money. They're trying to teach you how to manage other people's money who have already got it. I'm trying to tell you how the markets move exactly and precisely with clear, informative, realistic, and of course, obviously honest perspectives. This is what happens. If you want to see the direction the macro economy change, specifically the influence of the market, you have to look at the economic drivers. Right now, we have seen the economic drivers be positive, right? We've seen falling inflation and we've seen decreasing rate hikes in terms of percentage change over time. That therefore means the direction of these rate hikes, meaning 0 point positive and negative interest rates, or interest rates positive, 0 negative, the pivot being here, we have seen this. Right? We have seen this. We're creating a trajectory towards a pivot, and therefore the markets have gone upwards. Now, what we have just seen is CPI is up 0.4% on the month. Okay? PPI is up 0.2% on the month. NFP is up 180,000 jobs. Okay? This is all signs of rising inflation. If inflation continues upwards again, we're going to see the rate of change for the interest rates increase. We're going to start to see us go from this, which is expected, okay, to this. We're going to get a little pivot, a little jump. And if we get that jump, that deletes the current perceived systematic risk. It turns it up and it deletes the current trajectory of the economic environment for asset prices. And that could shift the macroeconomic perspective for asset prices. If we see interest rates get shifted away from the current narrative, which is we're going to hold where we are, and we're slowly going to a pivot to inflation is starting to rise again, we might need to ramp up interest rates. If that happens, if you see that happens, that is when new lows are possible, not a second sooner. It doesn't matter what you say, that is the reality. Economic drivers move macro price action. If that doesn't happen, we're not going to see new lows. But if that does happen, we're definitely going to see new lows, guys. So keep that in mind. Let's go to the short-term price action. What we are seeing here is, of course, a bullish downtrend. This is a descending channel. If the descending channel breaks towards the upside, we can see a rally upwards. Now, it doesn't matter where we go between these resistances here, up over here. The bulls do not have control until two things happen. Number one, the bulls need to flip momentum on the daily chart. The bulls need to regain momentum on the daily chart. How the hell do they do that? Well, this RSI trend line needs to break. The RSI trend line needs to break. If the RSI breaks upwards, the bulls regain control on the daily chart. That will push the price over 30,000. Number two, the bulls do need to reclaim on the smaller time frame the $19,200 level, which is now going to be sitting above this downtrending resistance. Until then, every bounce should be considered bearish reversal. Every bounce should be considered a dead cat bounce that could potentially take us even lower. So watch those levels, guys. Now, I've run out of time today. I can't get into it too much more. I don't want this video going longer than 30 minutes. So I'll quickly summarize by saying, right now, the charts are looking weak on the daily. They're looking weak on the weekly. They're even looking weak on the monthly. But this weakness hasn't developed into bearishness yet. Keep that in mind. The weakness has not developed into bearishness yet, okay? The weakness will develop into bearishness if 25.2 to 24.4K is lost. If those levels are lost, that is when we are at risk of going to new lows. Until that happens, every correction from 30,000, as I have been saying this entire time, should be considered a healthy correction. Now, could this be incorrect? Absolutely. But will it be incorrect based on anything other than the economic drivers changing? Absolutely not. Spontaneous price action doesn't occur. There can be manipulation. There can be market spoofing. There can be all this kind of stuff. But for that macro direction to change, we need to see the risk environment or risk climate shift, okay? Keep that in mind. Right now, the short-term price action, we are in a downtrend. I expect the prices to go lower unless this trigger can break. If the trigger can break, we're looking for POC, we're looking for 27,800, we're looking for 20,800. We break through those levels, we look for this downtrending resistance, okay? If we continue lower, we have to see a loss of that prior support. have to see a loss of 26,000. We actually ideally have to see a loss of this little gap over here on the VRPV. 25,600, loss of 25,600 is going to take us to 25,200. So watch those levels, guys. I hope you enjoyed today's video. I hope you learned something. If you got any questions, let me know below. Thanks for watching, and I'll see you guys in the next one.